Our topic for today is effectively Solvency II, and we're going to try to cover the major challenges that insurance companies are facing due to this change of regulation. First of all, we have to bear in mind the major trends and opportunities that insurance companies are facing at the moment. One of the major current trends is the rapidly changing macroeconomic environment, the persistent pressure on the profitability of insurers, the digital revolution, and the most important thing, the increasing regulatory environment. All of these have as a consequence a continuous pressure on insurer business models. As everybody knows effectively, the global financial crisis in 2008 brought about a global deleveraging that led to a severe global recession. Global monetary authorities had to intervene and effectively provide massive stimulus in order to prop up economic activity. The massive stimulus that has been provided in various methods and ways, either through a massive cut in interest rates or massive quantitative easing programs, has effectively resulted in what is called the zero interest rate policies, which major developed countries are facing at the moment, as well as, for the first time, negative interest rate policies in certain countries like Sweden or Denmark. As you can imagine, the environment is uncharted. At least during our generation, we haven't seen interest rates cut into negative territory. And of course, that has induced increasing volatility in financial markets, having specific consequences for insurance companies. On top of that, we have a huge trend in terms of digitalization. This increased digitalization brings about increased market competition. The underlying business models are rapidly changing. There's more and more need for innovative insurance products. For example, the global trend in hacking has brought about a demand for cybersecurity insurance. And effectively, all this digitalization has specific consequences for insurers in terms of opportunities and risks, and the specific need of a holistic risk management approach. Now, as we previously mentioned, the low yield environment puts immense amount of pressure on the profitability of insurers, as well as the performance of their investment portfolios. And that is why insurance companies need to become increasingly cost-effective and adopt more flexible business models. But more importantly, there is increased escalation in the regulatory environment, and the regulatory environment tries to take into account the so-called stakeholder-driven regulation, as well as specific policies that will ensure financial stability and sustainability. Now, this is a graph that I particularly like. It shows the influences on risk management from specific events. So what you can see here on the chart is the word SHARP, which is basically, for those of you who know, the mean variance optimization model and the SHARP ratio and the market beta. You see events such as LTCM, WTC, black swans, the global financial crisis, etc., etc. Now, the importance of this chart is that effectively regulation is always retroactive rather than proactive, meaning that there is a specific event that happens, and then the regulator comes ex post and tries to patch up the holes that the specific event has produced. And that's why regulation is effectively evolving. It's not something that remains solid and stable. It's a dynamic process, and that's what this graph shows. As I've already mentioned, the rationale behind risk management regulation is effectively to ensure stability and sustainability in the financial system, be it the banking sector or the insurance sector. In practical terms, that means that the solvency and the economic stability of financial institutions has to be safeguarded. Going back in terms of history, Solvency II has been based on specific banking regulation based on the BIS, the Bank for International Settlements, and what all of you probably have heard, Basel II, and more specifically Basel III, especially after the events of the global financial crisis in 2008. Now, Basel III specifically has set out as main objectives to strengthen capital requirements in financial institutions, and especially banks, in terms of increasing liquidity and decreasing leverage. Now, why did we go back to Basel III? Solvency II is a so-called three-pillar approach and is based on the three-pillar approach of Basel III. So the first pillar has to do with the quantification of risk and the specific guidelines in terms of minimum capital requirements and solvency capital requirements, as well as the quantification of various risks. The second pillar has to do with the so-called regulatory controls, so the risk management framework that insurance companies should have, the internal controls, as well as the corporate governance and compliance framework. And the third pillar, which is very important, has to do with the transparent disclosure of requirements. So insurance companies will have to disclose to regulators and the markets specific things that have to do with breaches of capital, minimum requirements, minimum capital requirements, risk management frameworks, etc., etc. The start date of Solvency II, probably most of you know that, is January 2016. Now, I'm not going to go through the details. I'm sure that the presentation will be distributed at the end. But the things that you have to bear in mind is that for the first time, the regulator obliges insurance companies to report any breaches in terms of solvency capital requirements. So if an insurance company does not fulfill the SCR, it needs to report it to the regulator. So the regulation, as you can imagine, is very extensive. It also set out how the quantification, the way that the quantification of this risk is going to be brought about, meaning that the regulator is trying to standardize measurement and quantification across countries, across territories, because it's more easy for them to oversee what is going on in the underlying market. So there is what you see there as a standard formula calculation, is effectively a standardized way of calculating a number of risks. On the other hand, if specific insurance companies think that their business model is very different, they can effectively opt and use an internal model, although in order to adopt this internal model, that has to go through the regulator's approval, or what they call a partial internal model, which is basically a combination of the standard formula calculation and parts of an internal model. The interesting part, again, with a specific regulation is that we have a very accurate definition of own funds, of what is classified and defined as own funds. And on top of that, for the first time, we have the so-called prudent person principle. Now, this is very important, I think, because for the first time, the regulator is setting guidelines, at least in this way, in terms of how insurance companies should invest their assets. So we see words like diversification. We see that derivatives should be used as for hedging purposes only and not for speculative purposes, as was the case in 2008, 2007, and in earlier years. So the regulator is trying to avoid a repetition of the events that happened during the global financial crisis. The same thing, the general regulatory principle, the corporate governance system that every insurer has to have, specific internal controls. The regulator specifies that key employees, meaning board members, chief risk officers, the CEO, the CFO, the COO, must be professional and responsible for their decisions at all times, meaning that the regulator is trying to make the company responsible for its actions. Another very important aspect of the regulation is what is called the own risk and solvency assessment framework, ORSA, which is effectively the responsibility of an insurance company to report to the regulator their assessment of their own risk management framework, internal framework. So again, the supervision is covering, the Solvency II is a framework that is very holistic and comprehensive and covers a number of areas, from governance procedures, calculation of solvency and minimum capital requirements, evaluation of risk and capital, evaluation of investments, quality and quantity of own funds, and compliance. And for the first time, it specifies the underlying power of the regulator. In terms of financial disclosure, insurance companies will have at least on an annual basis to report on the items that you see on this slide. So a description of their business and their performance, valuation, risk management processes, solvency capital and minimum capital ratio reporting, internal model description, breach, as I said before, very, very important, the breach of their capital requirements. Effectively, the regulator is trying to make this process as transparent as possible so that every analyst, insurance policyholder, etc., is aware of what is going on. So I'm probably running out of time. So there are a number of internal processes that Solvency II will effectively impact. So the operating model of insurance companies, the way that technology is treated, the internal organization, and the risk and compliance framework. Especially on internal organization, very skilled workforce is going to be required, and probably insurance company employees will have to become more risk-oriented. There needs to be a change in the culture. So what I said, internal guys, so strategic transformation, cultural transformation, workforce transformation, set out specific compliance objectives, have a very specific risk and compliance framework, and conduct risk assessments. So the new environment, as we call it, requires a tighter link between an insurance company's corporate strategy, its capital allocation, and a very precise performance measurement system. That will also have specific implications for their ALM management and their ALM framework. And last but not least, the new environment requires a very strict methodology framework in terms of the quantification of risks. So main requirements have to do with data quality and integrity, effective IT systems, solid quantitative analysis, as well as extensive scenario and stress testing. Well, that's it in a nutshell. Thank you very much for your attention.